Welcome back. I know it's been a while. I appreciate everybody staying subscribed. If you stayed subscribed, if you're new to the channel, welcome to the channel. It's been a little over a year. Quick life update. My wife and I have our second baby now that's a little over a year old. So if you put two and two together, that's why it's taken me a little bit to get back into posting. But the second thing is that the number one request I got every single time I made a video was for my software. And what I've done is spend a lot of time and money getting it on a website that I can share with everybody. My vision for the software for the site was to create a very simple and intuitive stock analysis and valuation tool that was on top of a lot of complex formulas that's necessary, obviously, to do this. So my plan for this video is to walk you through Adobe to kind of show off the website. And before I start, this is live now. You can sign up. There's a free version. There's a premium version that has a 14-day free trial. And if you sign up before the end of August, we'll hold that special launch pricing for at least 2 years, because I do see this growing. I have a vision of making it a one-stop shop for everything value investing related, but that's going to take a lot more money and a lot more time. And frankly, we need users right now to make this work. So try it out. Let me know what you like. Let me know what you don't like. Tell me what you think is missing. Use this little chat button here at the bottom. That's how you can get in touch with developers. So anyway, I do want to go through Adobe, but I want to just highlight a few of the high-level stuff about this software because it's so neat, right? So you type in any ticker. I have Adobe up right here. Let's just say I pick a random one. I don't know. How about Wendy's? Seems to be the rage, right? All right, so you have your stock information, highlights. You can hide that. Some people like to do a valuation without looking at the stock price. So if you like to hide it, you'll keep it hidden. You have past historical financials going back 30 years, quarterly, annual. You have let's go back to revenue. You have a CAGR calculation there that you can manually input, which is helpful. There's a table if you don't feel like reading a chart with the average values. Income statement, balance sheet, cash flow. And then this is one I really like, the ability to make your own custom metrics. So let's say you want to do return on equity or something that doesn't show up in the financial statements, or something unique like how I do free cash flow minus stock-based compensation, right? To look at free cash flow. And so you would just come in here and it opens up this little box. You can name it what you want. Search for the formula, like I would do free cash flow minus, and then search for stock-based compensation. And I'll just call it adjusted free cash flow. Save it, and then I can view it, right? I can view it on annual, quarterly, any date range, a custom date range, that sort of thing. And then lastly, 3 separate valuation tabs. So you can, like the DCF, and the DCF I love because the way that we have it calculated right now is whenever you put in your discount rate and your margin of safety, it spits out a normal distribution. So it runs a simulation between all these values that you put. If you put 5 to 5 or minus 10 to 5 or whatever, it's going to run a fair value distribution for all of these outcomes, plot them here, then tell you where the current price is, and then where your margin of safety, the current price divided by your 1 minus your margin of safety is, which is basically like your deep value zone. So you would look at this, and if you see a lot of green, that's good. If you see a lot of red, that's not good, right? And then my favorite thing is this button here, save valuation, because you can save this and write notes, let's see, and come back to it later, and I'll show you how that works. So if I were to save this, I can go to my valuations. It's got the type that you did, ticker, when you did it, what was the price when you did it, and then a potential upside to what the price is now, right? If you open it up, it has your notes and everything. And this is my way of automating that journal theory that Warren Buffett always talked about with investing, that you have to keep a journal every time you buy stock, or every time you do a valuation on a stock. You really should write down what you thought, because the market changes, sentiments change, you might be influenced by that. So it really helps to go back and look at, oh, this is what I thought 6 months ago. I've already used this a ton. Going back, let's go to Adobe. Well, just real quick, there's other valuations of future PE, of book value, one that pretty much whenever it comes to a company that needs to be evaluated this way, we'll do it on the channel. But it's basically just a waterfall chart of the equity. Let's see. I'm just making up numbers at this point. But it shows you what your book value now, what your retained earnings. It discounts those back to net present value, add your margin of safety to kind of give you a calculated entry price. So that's another one I really like as well. So this was a video about Adobe, so we need to go to Adobe. Adobe is an extremely interesting story because 5 years, the stock has dropped from $600 a share to $200 a share. So it's been cut by 2/3. All right. In that same time frame, your revenue has gone from 15 billion to 23 billion. Your income has gone from, let's see, where's net income? From like 4.8 billion to 7 billion. So your stock's been cut by 2/3 and your income's gone up, what is that? 50% or so? I have a calculator here, so I don't have to worry about this anymore, having a calculator on the screen. So 7.13 divided by, what was it over here? 4.8. 4.8. It's gone up 50%. Yeah. See, I didn't need the calculator for that. Anyway, so that alone is crazy, right? Of course, the story with Adobe is that everybody is afraid that AI is eating their lunch and going to wreck their business model moving forward. That's the negative story that's driving, especially the recent stuff, right? All right, moving on to the balance sheet. Always like to look at, what's the health of the balance sheet, right? So one neat feature here is that you can add a second metric. You can put them on the same scale, have them on separate scales. I like to put the same scale and do assets and liabilities and just look at that difference, right? To make sure, you're at $30 billion of assets and it's a lot of liabilities, but how much of that is debt? Let's see. Only 6 billion debt. So it's mostly tied up in other liabilities and stuff. But my favorite thing to look at in all stocks, of course, is cash flow, right? Look at this operating cash flow. And I love looking at quarterly. And my favorite thing that I don't see anybody else do, but we have it on this website, is the rolling trailing 12 months. It's a way to get as many data points as you get with quarterly, but you smooth out that curve so you don't get the ups and downs. Basically, it's just continuously sums the last 4 quarters, right? All right, so free cash flow of Adobe is just booming, right? The last quarter low, right? So they're in, maybe the bear case is that it is going to wind up, let's say, down here or something. But in general, if you look at free cash flow on a rolling basis, it's just going up, right? However, I don't like to just use plain free cash flow for valuations. I like to look at adjusted free cash flow. That's kind of what we talked about. But then even better than that, adjusted free cash flow per share. So I'll do adjusted free cash flow per share. I'm going to do free cash flow minus stock-based compensation divided by the number of shares, right? Diluted number of shares. And that'll get me, and look, it gives you a preview of the 5 quarters so that you can make sure you don't have some kind of crazy number in there and you had a math error. And if you want to do it as a percentage, you can, if you're doing a ratio or something, but this one's a dollar amount. All right, so one thing that's interesting here is the adjusted free cash flow per share versus just plain free cash flow per share. So if I were to do just free cash flow per share, I'm sorry y'all are having to watch me make all these. I should have done this before, but let's see, diluted average shares. If I do free cash flow per share, we're in the $23 a share. If I do adjusted free cash flow per share, it's more like $18. That's a pretty big difference. That means that you're losing $5 a share to dilution. That seems kind of excessive, right? But anyway, let's move to that DCF. So if I go to valuation, here's my DCF. The starting free cash flow was what? 1852. 1852 is what I'm going to use. Annual growth rate. What do I think they're going to do in the next 5 years? Well, they've been growing like crazy. If I look up this, 11% a year from 12 to 18, I'll put that as my high end. How about that? And then the low end would be, what if they stall? What if they stall at 18, right? That it really is some of their business models getting eroded, that sort of thing. And then long-term growth, I always put like 1 to 3. Sometimes I put zeros there, just if I'm trying to be really conservative. Then your discount rate, I've been using 12 with a margin of safety of 33%. And what you can see is that, the scenario says median output was 221, which means in this model that you built, 50% of the fair value falls below, 50% falls above. That means at the current stock price, about 70% of scenarios fall above what it's trading at now, based on these assumptions. And then call it 5% are in the deep value, meaning this is literally just what fair value do you require to buy the stock at its current price, right? So like if I were to change this to 25, it would shrink that gap. If I have it at 0, then it's just the straight line, We could save this. You know what? I am going to save it. I'm going to save the valuation. I'm going to say Adobe Video. Save it. Another one we'll do is the future PE. So this one, you can get the earnings per share here. Let's just say 3 years from now, if they're making, let's say worst case, they hold. Best case, they grow up to meet the free cash flow, or let's just say 23. Let's say they don't get all the way there. And the PE, right now it's at 11. I think that's pretty low, but we'll say 10 to 15 with a discount rate of 12. And see, you get a much different valuation. So if I were to put the margin of safety, this one says the median's more like 180. But it's all assumption based, and that's the key thing to keep in mind here, is that especially the growth numbers, anything that gets raised to an exponent is going to make a huge impact on your overall valuation. I mean, shoot, PE makes a big impact too. So if it's traded at some of these multiples that other tech stocks and AI stocks are trading at, I mean, you're grossly undervalued, So it's fun to do. It's fun to run these scenarios. You could put huge ranges on here, 10 to 30, big spreads. What if they make 30 or 15, and just kind of see how the scenarios play out, right? Anyway, Adobe actually is a stock I own. I bought it, I think this week or last week, and just some of the stuff that we talked about, cash flow generative. I like that it's trading really cheap compared to other tech AI stocks, right? And then if you look, let's see, what else do I like? Share buyback. So that would be, if you look at the diluted number of shares, this is what I love. I mean, look at what they're doing on a quarterly basis in the last 5 years. They're retiring a lot of shares. So 3.4% of shares a year. If I were to make that just the last 2 years, it's 5.5% a year. If I just make it the last year, 6.5% a year. So they're putting a lot of their cash flow, actually they're putting more than just their free cash flow back into buybacks, and that plus the cash flow is just two huge check marks for me. If the company's making a lot of free cash flow and then putting it back in the company in the form of buybacks at a low multiple, then that's that seems like a pretty good formula, right? Anyway, that's all for this video. I really hope you check out the site. Really looking forward to everybody's feedback on it. And I'm hoping that we're able to really grow it and add some more tools and stuff, both to the free side and to the premium side. So thank you again for watching. I'll see you soon.